Right now, while you're watching this, the biggest wealth transfer in modern history is being set up. And most people have no idea it's coming. Hi, my name is Bob, and I've spent the last 2 decades studying market cycles, financial crashes, and how regular people can actually profit from them. And what I'm about to share with you isn't fear mongering. It's based on real data, historical patterns, and numbers that Wall Street professionals are watching right now. By the end of this video, you'll understand exactly what's coming in 2026, and more importantly, how to position yourself to benefit from it instead of becoming another victim. So make sure to stay until the end, leave a like, and let's start. Let me ask you something. Have you noticed how everything feels off right now? The economy is supposedly doing fine, but your grocery bill keeps going up. The stock market keeps hitting new highs, but layoffs are happening everywhere. Interest rates are at levels we haven't seen in 20 years, but people are still taking out massive loans they can barely afford. Here's what's really happening. We're in what economists call a late cycle bubble, and I'm going to break that down in simple terms. Think of the economy like a balloon. For years, we've been pumping more and more air into it. Cheap money, low interest rates, stimulus packages, you name it. And right now, that balloon is stretched so tight that even a small pinprick could pop it. The numbers don't lie. According to the Federal Reserve's own data, the total market capitalization to GDP ratio, that's the Buffett Indicator, is sitting at around 200%. To put that in perspective, anything above 120% is considered overvalued. The last 2 times this ratio got this high was right before the dot-com crash in 2000 and the housing crisis in 2008. Both times, the market lost 50% or more of its value. But here's where it gets interesting. Every single time the market has crashed, it has also created incredible opportunities for people who were prepared. In 2008, investors who had cash and courage bought companies like Apple for under $10 a share. Amazon was trading at $35. Netflix was less than $4. Today, those same investments would have made you 20 to 50 times your money. The challenge most people face is this: they don't see the crash coming. And even if they do, they don't know what to do about it. They panic, they sell at the worst possible time, and they watch from the sidelines as the smart money quietly buys everything at a discount. So let's talk about the warning signs that are flashing right now. And I want to be clear, I'm not making predictions based on feelings. These are facts backed by data. First, let's look at interest rates. The Federal Reserve raised rates from basically 0 to over 5% in less than 2 years. That's one of the fastest rate hike cycles in history. And here's what most people don't understand. Recessions don't start when rates are going up. They start when rates start coming down. Why? Because the Fed only cuts rates when the economy is already breaking. They're trying to save a patient that's already sick. Every major recession in the last 50 years has started within months of the Fed beginning to cut rates. It happened in 2001, it happened in 2007, and the Fed started cutting again in late 2024. If history repeats, we should expect serious economic problems by mid to late 2026. Second, let's talk about the housing market. Right now, the median home price in America is higher than it was at the peak of the 2008 bubble when you adjust for inflation. Think about that. We're more expensive now than we were at the top of the biggest housing bubble in history. And this time, people are taking out mortgages with 7% or even 8% interest rates. The math doesn't work. A $400,000 house with an 8% mortgage costs about $3,000 a month. The average American household income is around $75,000 a year. That means nearly half of someone's gross income would go just to the mortgage before taxes. It's unsustainable. Third, corporate debt is at all-time highs. Companies borrowed trillions of dollars when money was cheap. Now they have to refinance that debt at much higher rates. According to Bloomberg, over $1.5 trillion in corporate debt needs to be refinanced in 2026. Many of these companies won't be able to afford the new interest payments. That means bankruptcies, layoffs, and more economic pain. Fourth, consumer debt is exploding. Credit card balances in the United States just hit $1.13 trillion. That's the highest it's ever been. And the average interest rate on those cards is over 20%. People aren't buying things because they have money. They're buying things because they have credit. And when the bills come due, defaults will skyrocket. Now let's look at the stock market itself. The price to earnings ratio for the S&P 500 is around 25. Historically, the average is about 15 to 16. That means stocks are trading at about 60% above their normal valuation. And we're seeing insane valuations in tech stocks. Companies with no profits trading at 50, 100, even 200 times their revenue. This isn't investing, it's speculation. And when speculation ends, it ends fast and violently. But here's the thing, none of this means you should be scared. It means you should be prepared. Because if you understand what's coming, you can position yourself to take advantage of it. Let me give you a real example from history. During the 2008 financial crisis, Warren Buffett's company, Berkshire Hathaway, had almost $50 billion in cash. While everyone else was panicking and selling, Buffett was buying. He invested $5 billion in Goldman Sachs, $3 billion in General Electric, and billions more in other companies. Within just a few years, those investments made him tens of billions of dollars. Or look at Michael Burry, the guy from The Big Short. He didn't just predict the housing crash, he bet against it and made over $800 million for his investors. How? Because he prepared before the crash happened. He studied the data, saw what was coming, and positioned himself accordingly. And it's not just the famous investors. Regular people who kept their heads during past crashes built incredible wealth too. Think about someone who invested just $10,000 in an S&P 500 index fund in March 2009, when everyone was saying the world was ending. That investment would be worth over $70,000 today. That's a 7 times return. Or imagine buying Bitcoin in 2020 when it crashed to $4,000 during the COVID panic. Just 18 months later, it hit $69,000. That's over a 17 times return. The pattern is always the same. Maximum fear equals maximum opportunity, but you have to be ready before it happens. Now let's talk about some specific sectors and areas you should be watching. Technology stocks have been on an absolute tear. Companies in artificial intelligence, cloud computing, and software have valuations that make the dot-com bubble look reasonable. When I see a company with $100 million in revenue valued at $10 billion, that's not investing. That's gambling. And when the music stops, these are going to be the first to fall. But here's the opportunity. After they fall, the real companies with real profits will be on sale. Microsoft, Google, Apple, these businesses aren't going anywhere. They print money, they have massive cash reserves, and when they drop 40% or 50% in a crash, that's when you back up the truck and buy. Real estate is another huge opportunity right now. Investment properties are priced assuming interest rates will stay low forever and rents will keep going up forever. Neither of those things is true. When the crash comes, you'll see foreclosures increase, forced sales, and prices drop. That's when you can buy rental properties or your first home at prices that actually make sense. I also want to talk about something most people ignore, the bond market. When stocks crash, investors run to safety. That means government bonds, especially treasury bonds, typically go up in value during crashes. If you have some of your money in bonds, it can help cushion the blow and give you a dry powder to deploy into stocks when they're cheap. You don't need to be a billionaire to use the same strategy. You just need to understand the game. And more importantly, you need to act before everyone else figures it out. Here's the moment of truth: the crash is coming. Not because I say so, but because the math, the history, and the cycles all point to the same conclusion. But the real question isn't if it's going to happen. It's what are you going to do about it? This is your chance to get on the right side of history. And I'm going to give you the exact playbook that professional investors are using right now. Step one, build your cash position. I know what you're thinking. Cash loses value to inflation. And you're right, but here's what matters more. Cash gives you power when everyone else is desperate. When the market crashes by 30%, 40%, or even 50%, your cash will be able to buy assets at massive discounts. Warren Buffett currently has over $300 billion in cash and short-term investments. Why? Because he's waiting for the sale. You don't need to sell everything, but you should have at least 20 to 30% of your portfolio in cash or very safe short-term investments. Think of it as your opportunity fund. Step two, make your shopping list now. Right now, while your mind is clear, write down the best companies, ETFs, or assets you want to own. Look for businesses with strong balance sheets, low debt, consistent profits, and products people need no matter what the economy does. Think companies like Microsoft, Johnson & Johnson, Procter & Gamble, or Costco. These are businesses that will survive and thrive no matter what happens. Also consider index funds like the S&P 500 or total market ETFs. When the market crashes, you'll be able to buy the entire American economy at a discount. Step three, don't try to time the bottom. Nobody, and I mean nobody, can perfectly time the market. Instead, use a strategy called dollar cost averaging. When the crash happens and prices are falling, start buying in small amounts. Buy a little this week, a little next week, and keep buying as prices drop. This way, you average out your entry price and you don't risk going all in right before another leg down. Step four, diversify intelligently. Don't put all your money in one thing, spread it across different asset classes, stocks, bonds, real estate, maybe even some gold or Bitcoin if you understand them. The goal isn't to predict which one will do best, it's to make sure you're in the game when the winners emerge. Step five, control your emotions. This is the hardest part. When the crash happens, the news will be terrifying. Your friends and family will tell you to sell. Your portfolio will be bleeding red. And every instinct in your body will scream at you to get out. But that's exactly when you need to do the opposite. That's when you buy. The people who got rich in 2008 weren't smarter than everyone else. They were just willing to act when everyone else was frozen in fear. Let me paint a picture for you of what 2026 might actually look like. Stocks drop 35%. The media talks about recession every single day. People are worried about their jobs. Consumer spending falls and fear is everywhere. But underneath all that chaos, something incredible is happening. Quality companies that were trading at 30 times earnings are now at 15 times earnings. Real estate that was overpriced is now affordable again. And the people who prepared, the ones with cash and a plan, are quietly building generational wealth. This isn't theory. This is exactly what happened in 2009 and 2002, in 1991, and in every crash before that. The market always recovers. It always reaches new highs. And the people who buy during the fear always win in the end. So here's what you need to remember. The 2026 crash isn't something to fear. It's something to prepare for. The warning signs are already here. Extreme valuations, massive debt, rising defaults, and economic fragility. But now you know what to do. Build your cash position so you have buying power when prices drop. Make your list of quality assets you want to own. Don't try to time it perfectly. Just start buying when fear is at its peak. Diversify across different investments, and most importantly, control your emotions when everyone else is panicking. The truth is, every market crash in history has been a wealth transfer. Money doesn't disappear. It just moves from the unprepared to the prepared, from the emotional to the disciplined, from the fearful to the courageous. And you now have the knowledge and the strategy to be on the winning side. The next 12 to 18 months are going to be critical. Use this time wisely. Don't wait until the crash happens to start thinking about your plan. By then, it'll be too late. The people who win are the ones who prepare in advance. This is your opportunity. The same opportunity that created millionaires in 2008, in 2000, in 1987, and in every major crash before that. The only question is, will you take it? If this helped you, hit that subscribe button so you don't miss what's coming next. See you soon.